Good evening and welcome back to At Home in Bethel Park. Today our guests are Mr. John Amrine, President of West Penn Financial, and Mr. Dan Volpatti, Senior Loan Officer, also with West Penn Financial. Some of you may know Dan. He's a lifelong resident of Bethel Park, and he has a satellite office right here in Northwood Realty, right here in Bethel Park, and you may be familiar with him. And many of you will remember John. John was with us about 4 years ago when we had a show detailing how Bethel Park residents could get out from underneath foreclosures and upside down mortgages. It was a pretty bad time in real estate, and John gave us some valuable advice that many of you were able to use, and we're very grateful for that. And today we're here on a bit of a brighter note. We're talking about a new day, a new mortgage market, and John, I'm going to turn it over to you. What have you noticed different?
Thanks very much, and thanks for having us back today. One of the issues before we talk about the new mortgage market, I'd like to have just a brief history lesson to understand where we are today, but how we got here. Mm-hmm. 4 years ago, we had a totally different environment. Yeah. We were in the midst of a financial crisis that was brought on not just by the mortgage market, by proliferation of issues on Wall Street. We had a lending environment whereby we had a multitude of programs that did not take into consideration consumers' ability to repay those debts. We had a stated goal, which albeit was a good goal, of attempting to have 70% of Americans owning a home, which is a great goal. However, to get to that goal, the industry had to do one of two things: either expand the programs that were available, or reduce the underwriting criteria. Well, the industry did both. And what was not anticipated was the housing bubble collapsed. Yeah. That bubble burst, and in many markets, we saw substantial devaluation of real estate. Now, in our market, it wasn't that substantial as in other markets, but yet we saw an unprecedented increase in mortgage delinquencies and mortgage foreclosures. Because of those issues, entered Dodd-Frank, the Wall Street and Mortgage Reform Act.
People have mixed feelings about this. I'm going to let you go, but I've heard many people say, oh, Dodd-Frank, and many people say, thank God for Dodd-Frank. It seems to be a mixed bag.
Well, I think as we go forward, and clearly as to the mortgage regulations, on January 10th of 2014, there were 4,000 new pages of regulations that the mortgage industry has to wrestle with. Until we see trends developed, I certainly think we're going to hear about some unintended consequences because there is absolutely a change in the qualification criteria for mortgages. We have a whole new array of items that we as mortgage bankers have to look at. Leading that list is qualified mortgage. Most everyone has heard the term qualified mortgage. Yeah. But what they don't understand is the definition of qualified mortgage. Mm-hmm. The qualified mortgage looks at a host of items that caused problems back in 2009 because of the financial crisis.
Okay.
Congress felt our housing finance industry was absolutely broken, and they have to fix it. Okay. And the fix came in the form of more regulations. Under Dodd-Frank and under qualified mortgage, lenders have to look at a number of components that were prevalent and may have led to problems in the mortgage industry in the past. Mm-hmm. And so with respect to the definition of qualified mortgage, a qualified mortgage can no longer have what the industry or what Congress likes to call as toxic features. And we know toxic as
that
being
sounds bad.
Right.
Yeah.
So a qualified mortgage cannot have a balloon payment.
Okay.
Cannot have a prepayment.
Now those arms where they got into problems were the balloon payment ones, correct?
That's correct.
Okay.
And that's where some of the problems that we look at. There are ARMs that are still permissible, but ARM loans that adjust every 6 months.
ARM loan again, just for new
It's
people?
an adjustable rate mortgage,
Meaning?
where the payment term, the interest rate is not fixed and will adjust at a predetermined time.
Yearly, biannually, whatever.
Annually, no more than annually now. We had ARMs that adjusted every 6 months at really difficult features and terms. Now there are specific prescribed adjustments.
Okay.
1 year, 5 year, 7 year, 10 year, those type of products. But even fixed rate in the past had prepayment penalties that weren't always properly disclosed. They were disclosed, but in many cases the consumers didn't know that they existed.
They didn't understand the consequence.
Right.
Okay.
So now, under qualified mortgage, you can't have a prepayment or a balloon payment.
I didn't know that.
Yeah.
Okay.
You cannot have a mortgage that exceeds a term of 30 years. At one point there were some 40-year mortgages being bantered about. No longer will that meet the definition of a qualified mortgage.
Okay. Makes sense.
In addition, you cannot have excessive upfront costs and fees. Now, the definition of upfront costs and fees is one where we may see some of the unintended consequences. On loans above $100,000, the limit of points and fees is 3%.
And the points again are if they want to buy down an interest rate.
Right. And a point, some participants in the past got confused as to actually what a discount point is. And truly, the definition of a discount point is that charge assessed that has a direct influence on a reduction in the interest rate. Under qualified mortgage, 2 bona fide discount points are exempted from that calculation, but they must have a direct bearing on a reduction in the interest rate. In the past, some industry participants, while they called the charge a discount point, it was really nothing other than an origination fee. And so if you call it what you will, but only a bona fide discount point has a direct relationship on the reduction in the interest rate.
And that, of course, reduces the monthly payment for the loan, the person taking out the home loan, and then allows them to qualify for a better mortgage.
True.
Yeah.
That's exactly correct. Yeah. The next item dealing in qualified mortgage relates to an ability to repay requirement, which Dan will cover in a bit.
Okay.
In addition to some of the new regulations, what are more disclosure requirements relate to the appraisal process. Now, one of the items that Dodd-Frank looked at is that in many difficulties relating to mortgages in the past, in some cases, and for a host of reasons, appraisals may have been inflated. Borrowers didn't receive or even be aware of the document that was utilized for the valuation of the mortgage. As a result, new appraisal requirements went into effect this year as well that are twofold. One is a disclosure requirement that is tied into truth in lending. Okay. And that requires every lender to inform the borrower of a disclosure within 3 days of the loan application that they will receive a copy of their appraisal or valuation promptly, but not later than 3 days prior to closing. And that is a disclosure that has to occur.
That seems to me a little awkward because my experience, and I don't mean to interrupt you, but my experience with appraisals is as a real estate agent. I'm always like, where's the appraisal? Where's the appraisal? I didn't realize that there was a problem with the banks not producing these appraisals.
Well, we didn't realize there was a problem either because we, as a matter of course, produced the appraisal.
Oh, yes.
Evidently, there were a number of instances where that was not the case.
Oh,
And so, in addition, the borrower gets the disclosure at time of application, and once the appraisal has been underwritten, a copy is then provided free of charge to the borrower. Now, free of charge is that the lender cannot charge the borrower for transmitting the appraisal to them.
Right.
The borrower still is required to pay the appraisal fee.
right.
So the appraisal fee is not waived. The cost in transmitting the actual appraisal report to the borrower, there's no charge for that event.
Okay.
But the borrower will still pay for the appraisal report that is used by the lender to determine whether or not the collateral for the loan is sufficient.
Mm-hmm.
So that's one of the new disclosures from the appraisal standpoint.
Okay. And then the regulation where the banks no longer have an input into what appraiser is chosen either. It goes to a pool. That's been 2 years now,
It
right?
goes to a pool utilizing a couple of factors. If you are a commercial bank, a community bank, federally regulated institutions, or mortgage bankers such as West Penn, you can administer your own roster of appraisers, but your administration must meet the strict guidelines of the appraisal independence standards.
Okay.
So that individuals originating the loans, such as Dan, are no longer permitted to have any impact whatsoever in the selection or the ordering of the appraisal.
Well, that makes a lot of sense because bad appraisal has a larger impact on a mortgage bank than it does on a mortgage broker. The bank has much more to lose than the broker.
True, but in most instances of, let's say, irregularities, of mortgage fraud, in most cases the appraisal was also suspect.
Okay.
And so as a result, to control that process, there are rather stringent guidelines that have to be employed relative to the selection and the ordering of the appraisal.
And that's good. That's very good. It's very good for the entire industry, real estate and the mortgage banking industry.
Another component relative to the disclosure requirements relates to home buyer pre-purchase counseling. In many events, I know for the clients that we service, the purchase of their home is probably the single largest investment that the consumer will make. And it's a complex transaction. In today's environment, it's even more complex. What the Consumer Financial Protection Bureau looked at in that regard is that consumers should have the ability to contact an independent third party and discuss the proposed mortgage application and mortgage product. So as a result, lenders have to give all applicants a notice at the time of application or within 3 days thereof that the consumer has the right to seek pre-purchase homebuyer counseling and provide them a list of 10 counseling agencies in their geographic area that they can select. Now, if they select them, it's not a cost that is factored into the mortgage process or even collected in the mortgage process. But the consumer can seek out counseling on their own. And right now, it is utilized through the CFPB website so that the lender really is at an arm's length concerning
And
these
CFPB
counseling.
stands for?
Consumer Financial Protection Bureau.
Okay.
They are, in the terms, the super regulator.
Okay.
They regulate every federal mortgage law except the Federal Housing Act. Those regulations are still administered by HUD and prosecuted by the Attorney General.
Right.
Every other federal mortgage law is regulated by the CFPB.
Okay. So outside of steering, I guess, would be the exception to what they
Right, steering is under the Federal Housing Act,
Right.
and so that jurisdiction still rests with HUD.
Okay.
Anything else relative to a mortgage is now under the auspices of the CFPB. I mean, in
And
the
you'll
industry,
tell us what steering is in a minute.
in the super regulator, there are all the other regulars still in place.
Okay.
We still have HUD. We still have state departments of banking. We still have the FTC. We still have the VA. So that's why we term the CFPB the super regulator, because they also are above and can enforce.
You know, a new player that's come on is USDA. They kind of a new player in the last 4 years.
That's true.
They do regulating too?
USDA regulates as well, and they also have the ability, and I suspect they will also issue their definition of qualified mortgage.
Okay, they're getting more popular.
They are.
I just ran into that.
And
It's not easy.
well, it's not easy in the standpoint if you're not familiar with their
I
regulations.
wasn't. Yeah.
And the USDA is not applicable in all parts of the county because it is determined based on population. But USDA has a number of programs. One is a residential program which we participate in.
Yeah.
But it's not mainstream because of in our area because of it is
Not
related
really
to
rural.
Rural
Yeah, this one
areas.
was down in Fayette City. It's pretty rural down there.
So when we talk about qualified mortgage as it exists currently, it's primarily conventional loans.
Okay.
HUD has issued a proposed rule on their definition of qualified mortgage. They are adopting the CFPB rule on points and fees, but they are not modifying their underwriting protocol,
Okay.
which is very important in this market. The VA and USDA also have the ability to promulgate rules as it relates to their loans. They have not yet done so. It is expected that they will. The VA has issued a lender information letter saying that any loan that qualifies under the VA program will currently meet the test for qualified mortgage. So, and USDA is much the same. I do suspect that the latter two agencies will adopt the CFPB rule for the points and fees test, but they will leave their underwriting criteria intact relative to the ability to repay analysis.
Okay. And that had changed too, and I know that you had gone over the fact that there's the criteria for their ability to repay was now going to be more stringent as far as their credit scores
It absolutely
and
is.
their debt to income ratio.
Correct.
And that was supposed to go into effect, and they've delayed that for just a short while, I
Well,
believe.
currently, as it relates to conventional loans, the ability to repay analysis is in effect today,
43.
43.
Yes.
And Dan is going to cover that
Okay.
in his portion concerning the ability to repay and the pre-approval process. But as we speak today on conventional loans, the 43% debt-to-income ratio is in place.
Okay. One question I wanted to ask you when you mentioned about counseling for mortgages. Does the state or the federal government provide that at free of charge, or is that an additional charge for a borrower?
In some cases, they do provide it free of charge. Now, in the list that we must provide to the borrower, they must be HUD-approved counseling agencies.
Okay.
The state of Pennsylvania, through their Housing Finance Agency, has a list of counseling agencies. I am not certain that all of those agencies are approved by HUD. And so that any agency that is derived by virtue of the notice is an agency that has been approved by HUD.
Okay. Okay. Now, let's see. Let's give you a little bit of an opportunity to chat a bit here. Why don't you just tell me briefly, let's start with Um, well, let's start with what we're talking about with the appraisal process and how we go from when somebody walks in the door and says, "Hi, Dan, I want to start getting a loan." How do we do this? We pre-approve them?
We have typically what I do. John is our regulatory and administrative expert, as you can tell, and I'm the guy on the street. So I'm working in the office over here at Norman Center, and I work with buyers on a regular basis. It's very typical in this market for people to get pre-approved. It's not a new phenomenon. It's something we've been doing for a long time.
And Northwood recommends that too, by the way, all the time. That way the buyer doesn't have any unrealistic expectation of what they're going to qualify for. It's an important step in the process.
Absolutely. There are, it's almost become standard procedure. The last thing any seller wants is to sign an agreement and then find out 6 weeks later that the buyer cannot get a loan. So what we do to kind of take a lot of the mystery out of the process is to talk to the buyers in advance. In 15 minutes over the phone, in most cases, I can pre-approve somebody. What we need to do is we start with their income, and then we do a preliminary credit report, and then based on income and credit, we can kind of work backwards to tell them what they qualify for. So in that time frame, I can tell them what they qualify for, what the payments would be, the kind of money they'd need, what program they most likely fit into.
And it's important that the buyers that are coming to you it's a confidential process. It's usually not shared with the agents unless the buyers want it to be shared with the agents. And it's between you and the person you're meeting, Dan, to take your mortgage application or your pre-approval. And it's very important that you be upfront with him because he can help you get through the rough spots, but when you're trying to hide things, it doesn't work real well for you as a buyer in the end. So being open and honest with you, I think, would be the best criteria. And then you work with people who have some bumps, don't you?
Yes. What we do is once we've approved somebody, and pre-approval means that we tell them in advance that we'll make them a loan for a specific dollar amount, so that then you as the agent can take those people out and look at houses. If they already have a house in mind, well, then we approve them for a specific property. If they don't, we're just approving them on a generic basis. The sellers have the assurance of knowing the buyer can get a loan.
It's a big deal.
There's a lot of foreclosed bank-owned properties out there. It's mandated that they have a pre-approval before they'll even consider an offer. And then for the borrowers, it's almost an educational experience, especially those people who have not purchased homes in the past. They really don't have a concept as to what the requirements are, what the costs are. And in most cases, when I tell somebody what they qualify for, they kind of moan and say, "Oh, I could never afford that much." So what I typically say is, I can tell you what you qualify for. You decide what you can afford. So then I issue a pre-approval letter. The agent gets a copy of that, and you guys are on your way looking at houses. Those people, and there are a number of them who may not qualify, then on a very preliminary basis, we can offer suggestions to determine what they need to do to get themselves either from an income or a credit standpoint to be able to qualify for the loan.
One thing that I ran into with my kids, they're graduating, and neither one of them had a credit card. And when they came home over Christmas, I said, "Get your credit card." And they were reluctant to do it. They have a limited income. I said, "No, get your credit card. Mommy will make sure that the balance is covered." But you need a credit history just to even start.
One of the most important things that I do is to pull a credit report. And the credit scores are what drives the financing. So of course, the higher the credit score, the lower the rate is going to be. And as you move down the scale, the rate moves up till at a certain point, you're not eligible for financing. And it may be counterintuitive, but you need credit. You need to have some credit. So somebody who pays cash for everything all the time, that doesn't work, because no credit is bad credit. The system wants to see that you have credit and you are able to manage credit. And credit cards are an important part of that process.
It's as I tell it to people and to my kids, it shows people that you want to be a responsible participant in the process and that you will be somebody that they can depend on.
Absolutely. That's the consideration,
Right.
right? And the market has changed dramatically over the past 5 years. 5 years ago, I always tell people, if you had a pulse, somebody would have made you a loan. Today, we check every freckle. So I tell people that six weeks ago, a month ago, I had a guy call me and say, "Why are you picking on me?" And I said, "We're not picking on you. We're picking on everybody." So we went from the point where we didn't check anything to we're checking absolutely everything. And that's the idea about the credit analysis. There was a time when we were making 100% finance loans, no income verification, no asset verification, with credit scores of 500. That was insanity, and we all saw how well that system worked.
Yeah.
Now, in general, the minimum credit score is 640. Anything below that, you're not going to be able to do any type of financing.
But there are places that you can go to get help to bring that score up. You just have to be willing to do that work to get it there. Go ahead.
Yes, absolutely. There are many agencies out there, and as John had mentioned about, we do disclose those agencies.
Under the
that will
counseling
help.
disclosure?
Yes. that
They will help
people.
those people too?
Yes,
Yes.
absolutely. And as Dan mentioned, we have moved from a risk-based environment to a rules-based environment, and the rules are very stringent.
Okay. Wow. Well, I just got a 2-minute warning, and I did not expect that. Thanks, Carl. There's so much to talk about in this mortgage market. It's not like it used to be. It's not like you can walk into somebody, John Q. Public, fill out an application, get a mortgage, and go home. You want to be with somebody you trust. You want to be with somebody who knows the ins and outs of the market, and you want to be clear about what type of mortgage you're getting and how it's going to affect you and your family's finances. John and Dan, thank you so much for coming. I think I'm going to have at least one of you back to finish this discussion.
Thanks for having us.
It's always very informative, and the people of Bethel Park and the South Hills love this information. One other place you can get this information, there will be a home buyers and a home sellers seminar held here in Bethel Park on February the 26th from 7 p.m. till 9 p.m. at the Bethel Park Community Center. And it will be sponsored by myself and At Home in Bethel Park and Northwood Realty Services. And you can contact me if you're interested in attending at 412-654-8195. Or you can go to the website, www.athomeinbethelpark.com. And I want you to know that Dan will be present at that seminar, and he will be available to answer questions. And don't think you have to be buying a home or selling a home to come. Come and use Northwood as your resource. Use At Home in Bethel Park as your resource. Use Dan as a resource to get your questions answered. And I want to thank you all very much for coming or for viewing today, and we'll see you next time at Home in Bethel Park.
BPTV. Come volunteer. If it wasn't fun, I wouldn't be here.
BPTV. Come on in, make a show. It's still fun after all these years.